Okay, it's 9 o'clock. If we could start the meeting, please. Roll call, please, Deborah.
Certainly. Green,
Here.
Star,
Here.
Castile,
Here.
Hines,
Here.
Jennings,
Here.
Singh,
Here.
and Byron.
Here.
Great. Next is approval of the regular meeting of the August 26th Finance Committee meeting. Two times, second. Any addition changes?
No.
Seeing none, those are approved. And then also the minutes of the joint budget meeting held on September 9th and 10th. Any additions, changes? Seeing none, those are approved. Any member forums?
So there's no in-person forum speakers and there are no Zoom speakers. That concludes the member forum.
Great. I have no announcements. Jeff?
We have a pretty full agenda here, so I'll refer to the items as they come up.
Okay,
All right,
next are the financial statements.
Cool.
Todd?
let's keep moving through. All right, so not to sound repetitive as from last month, but
Can you make that a little bigger? I'm sorry.
yeah,
That's great, thank you.
Thank you.
it's so funny. I just look at the computer, so you. All right, so we're still running very favorable on, we're starting with RWC. We're still running very favorable on that. With the large part on the expenses, we will still, as we've spoken to in the last several months, we're still actively going to be spending money on the facilities maintenance, right? So it's a lot of those expenses are still in, coming up in the rest of Q3, Q4. Both for, if we can just, we jump down to the operating expenses, you'll see over on the
Can I go back to salaries for a second?
Yeah,
Go back to
sure.
salaries. Did we envision that surplus?
we didn't envision it, it just,
No, I mean, do we envision staying the rest of the year? I mean,
we're gonna eat into it a little bit. We did have some open positions, so for example, based on, obviously the allocation, we've had some open positions we filled. So we're gonna chip away a little bit of it,
okay,
but it is, I do see us ending favorable for the year. So it's a good thing. We got through the year and, we always budget for full staffing and, we have variances for the year that, we don't necessarily fill it, which of course flows through all the other categories as well. So, and then like on the benefits and stuff, depending on if those people are open, that are left, have more dependents and less dependents, right? We can have some swings on the medical benefit side, obviously. So we still end the year favorable. So that is something we will be able to see at the end of the year. But we have, I don't think there's very many open positions right now. I don't think so. So I think we'll see, let's catch back up a little bit, but
okay, thank you.
be good, yeah. And then, sorry, I didn't mean to skip over that. Just on the operating expenses, you'll see that, the 355,000 we're over on facilities. That is obviously something we're gonna probably spend completely this year. So that will, obviously bring our surplus down. But that's just timing, as we've talked about in terms of how those dollars are budgeted. We should, as we move forward into next year and we seasonalize those expenses we've talked about, you will see that those next year when we're sitting here, you'll see that we're not really running a big surplus because those expenses will be out in the end of Q3, Q4. Same with the landscape maintenance. IT expense just has to do with obviously timing on getting also equipment repair and everything else in some of the billings. So IT expense too, we're running a little bit favorable. We will have some seasonality there too with some of the subscriptions. We brought on, we'll probably have a payment for Vermont Systems and some other things that will, from a subscription standpoint, that are, because we're all cloud-based on the model. So those, you'll see that be used up a little bit. And then administrative expenses, you'll also see that come down. Now that the audit is complete, we'll get some large bills from CBIZ and we'll take a whack at that. So I don't know if you haven't actually seen the final bill.
Speaking of that, is the audit finalized? Do we have the final report?
Not yet.
Okay,
We're gonna meet with Leanne. We have a letter to sign and it's all teed up.
okay,
So we'll have it this week, tonight even, probably. All right, so once again, we're favorable on RWC, which is great. And we are trending right where we want to be, certainly compared to the other one. I don't know, given our agenda, if we really want all the details here for every finance committee to go through. And I certainly welcome any questions to email myself or Amanda and to answer any detailed questions you may have. I think for time, you'll see that just like last month, we have the detailed budget to actual. And just remember, this is through August, so it doesn't show remaining budget. It just shows as a period of time where your variance is. We are working on finalizing the report that will allow us to close the period of August and show what's remaining in the budget, because I think I've gotten a lot of requests, and certainly on the mutual side as well, that it's very helpful to see what's left in the budget. This is not showing you what's left for the year. This is showing what's the variances for the year-to-date period. Okay. And then you also have in here the income statement as we continue to kind of, just continue to, I'll make this a lot bigger, sorry, everyone. We're gonna continue to show the actual P&L by month, all right? So you can see actually how the expenditures flow. And obviously as our budgeting exercise goes, we're gonna, start using a lot of this historical timing and trending for, how the 26 budget is out, is actually loaded in, so we can have that seasonal look now on our budgets going forward. So, and then I think this is our RWC, and then let's go to Rossmore Property Management. Okay, so on Rossmore Property Management, we are also favorable. Obviously, you can see from the gross profit line that we're actually running, and I'll show you the revenue detail here in a minute, but we're running favorable. A lot of that is in Yeru's world with building maintenance, is where we have some favorable variances there. And we'll go to that. Personal expenses, kind of the same conversation we had with RWC. We've had open positions. That's also one of my open positions too with, we've had a couple open positions in my team. If you remember from the budget conversations, those are both now filled, and one of them actually split with IT, moved to IT. So you'll see that kind of come down a little bit, but we're still favorable, and we're still going to be favorable. So I still think that we're going to have from the look at the year end, unforeseen anything, we're going to be, hopefully just continue to be a little bit above break even or chip away at that break even number, right? So it's a good thing. And then operating expenses are also light, but if we look at the revenue standpoint here real quick, you'll see where we're actually over on the billable services on the reserve side, slightly down what we budgeted on operating, but net resale inspection fees, alteration fees are actually, positive. We're going to see obviously that ties into certainly the inspection fees are going to tie into our conversation with MTFs, and so it is related to that. So these are timing on these. You'll see these booked after the fact. So as we look at the August MTF fees, you'll see this number kind of come down towards budget, right? Because it is tied to how many units we sell. So overall favorable on revenue. And then if we get into the actual personnel expenses we've talked about, we've had conversations on the benefit piece. It doesn't necessarily tie directly logically to salary and wages, because it really depends on the positions and the number of dependents. So if we hired someone with 4 or someone left that had 3, there can be huge swings on the medical benefit and expense side. And then finally on the operating expenses, we are quite favorable both on professional services and administrative expenses on the RPM side. I'd like to see that continue. So you have any additional comments. So I see this number coming, like I said, down a little bit closer. I don't think we're gonna carry the same full amount of surplus on both of them through the end of the year, but we will be in a pretty good place, and we're in a good place here through August. So no real surprises. I mean, I think that for me, obviously some of the labor savings, just having those open positions that we're seeing, something we can't totally project, but we're in a good place. So any questions? And then once again, you can go through all the details here as well.
Yeah,
Yeah.
Nancy.
Yeah, we had the forecast available for the budget meeting, but I'm wondering, like, going forward, because that's more interesting than just the monthly, if we could have that at these meetings so we can get a sense for where we're gonna end the year.
Yeah, so I think that is a fantastic, I've always thought we've always had the agenda item is financials and forecast. I think that Nancy, to your question, we want to get there. I mean, obviously it was a pretty big lift on the budget standpoint because it is a cultural shift for everyone to be looking at their individual monthly detail and getting it done. So instead of just closing the financials. However, with the reporting and workday now, that is absolutely something we're moving forward to. I would love to be able to produce as that terminal velocity comes in to actually produce a forecast. We have one here probably for Q4, probably. We are right now just in the midst of all the budget work we did last couple of weeks, closing all the financials we just did. And then obviously we're in the middle of all the mutual budgets, right? So it's kind of a bandwidth issue right now, but I do think that showing what's left and showing a forecast, I think that is a workday report that we can get to pretty quickly, hopefully.
So you're saying it would be dependent on the way you do that is literally to go to the heads of each
Sure.
department and ask them,
Yeah.
so not just.
You want it to be
finance.
accurate. I mean, certainly there is a feeling that, I think we can, we can probably get 60% there, but it really comes down to the managers and the timing and the expenditures. I mean, a lot of the things are obviously very straightforward, like revenue's flat. We know exactly what the revenue will be. But some of the things like on the revenue side and the earn side, will we get more work order deaths? Will we have more building maintenance revenue, right? We kind of need to go through culturally and say, what are the assumptions of those kind of forecasts? And then, like going through the department's head and saying, okay, what will you really going to spend for the next, few months, right? So I would say our forecast for that we did for the budgets is still accurate. It should be refreshed once we get through Q3, and maybe that is something we can bring to the committee for before we look at Q4.
Yeah, that'd be nice.
Yeah.
Okay. Any other questions?
I just have one quick question. So in the second slide, actually it's in the first slide, the actual expenses, administrative expense of 252.
Mhm.
And then when we go down to the operating,
Mhm.
the budget is 252. Do you have a problem with the columns being mixed up or? So administrative expense on slide 4.
You want RWC or RPM?
I'm in RPM, I'm sorry. I'm in RPM.
There's the two,
Administrative expense.
there's the
budget.
252
Yeah.
on the budget. So you're saying if you go up,
But if you go up to slide 1, the actual administrative is the 252. And I just noticed that particular one. I didn't look to see if all the other ones were pulled in.
keep
Do you
going,
see what
keep
go
going.
to 6B14? So you have the actual expenses are
Yeah.
252?
That's a good catch. I didn't catch that.
Really good.
61. And when I was reviewing this before, I didn't either. It just this
Oh, I
minute hit
didn't see
me.
that either.
So,
I could be on this particular file. We swapped the budget, I swapped last week, not the budget and actual
The
columns to
actuals.
match
the other,
NetSuite.
the other report, okay.
Let me look at that. I mean, obviously the
Yeah, that's
net
pretty,
income matches. It could be, this is a summary of the expenses for the chart, right? So if you were to look up here on the 467, Kim, you were to look at for example, this is the detail.
467 on
Yeah, if you were to look at
6B14, 467
yeah, if you were to
actual.
look at to the detail. I think it has to do with this summary. This is summarizing those categories, right? So,
Okay,
I mean, but
well,
that's.
maybe
a
you
good
just look at it
catch.
for next time.
Yeah, well, I'll send out a revised one. I hate it, but you look at the total gross profit, you scroll down into the actual detail of. This is full grade.
It's all right, Todd, just look
Yeah.
at
Yeah,
it.
just
It's
for
all
next
right.
time.
So I just want to say, I know
Yeah,
that
just send out
the
something,
Just
the total's right.
yeah,
I mean,
just
the
send
totals
something
are-
out to the
Yeah.
finance committee, please.
Yeah.
Okay, we have balance sheets yet?
We have the report created. We do not have the, which is a fantastic thing. However, we do not have the 24 audit roll through it. And so without all those adjustments, it's a fictitious balance from last year that doesn't, will just open up a slew of questions and
Will we have that by the next meeting?
you will. Matter of fact, I have like I said, I have the report. Actually looks just like the audit, where it actually has the 3 different pieces. It has just like we looked at the audit report, it has the trust piece, the regular RWC piece, and the RPM piece on one page.
Okay, good.
Next month, we'll see.
Yeah,
an
I just,
operating
we
statement, a balance sheet, and a cash flow, right? All three.
yeah, I mean, they're all attached, so the balance sheet's fixed, the cash flow works.
Yeah.
Right,
Okay.
and the report, like I said, we got the report all written, we were able to go in and add subsidiary into the filter, so now I can pull, just like you've seen in NetSuite, where I pull totals across columns, I can pull the subsidiaries. So now we just need to go through and get the right starting balance.
Yeah, we just need to start getting those reports every month.
Mhm.
Okay, we will look at cash, please.
Yeah. So this is obviously the trust package.
Yeah, can you make it bigger? Thank you.
Yeah. So this is obviously you can see the cash there, but it's also, just so you know, just like on the ones, the cash also has the piece down here, so we need cash on the trust. Remember, this is just the trust side.
Okay.
And then obviously, just like we've been doing, I'll make this bigger as well. We have been, this is all accounts across all 3, the trust, RWC and RPM. So we're at 14,778. Last month, we we're at 14,358. So obviously, we're still.
So I have a question about that. On 6/30, we were at 13,107. Then we went up by $1.3 million in July, and now we're up another 400 in August. So we've increased our cash by over $1.7 million in 2 months.
It's good.
We're rich.
So are we not paying people? What's going on? I mean, where did we get $1.7 million from?
There hasn't been a lot of capital spend, honestly. Overall,
Because I mean, like our checking account, the GRF checking account.
It's
went
gone up
from
at
one- From 1.3 to 1.8.
So, early,
500K in a
yeah,
month.
so there's been a lot of timing with our intercompany billings with the mutuals and I believe in June, we got caught up. And then July as well, the remainder. So each month, there's the work orders that are performed by MOD staff. That'll speak a little bit to MOD And then I would have to analyze exactly which accounts, but I know that there was some timing issues on intercompany billing, but what you're seeing in MOD mainly.
Can you look at that and get back to us?
And then we
please?
also got an insurance reimbursement that needs to be allocated.
How much was the insurance reimbursement, Amanda?
It was a little bit over $1 million.
Okay, so that.
That's 2/3 of it,
Yeah,
yeah.
yeah. Yeah, just when you see things like this, that you, well.
Right.
So I look forward to seeing the cash flow statement.
Yes.
You can observe where it's very, thank you.
And that million reimbursement is from us drawing it back down, the excess that was there?
No, that's the, when we are, according to our agreement with Gallagher, we have a flat fee for their services. And then any commissions that they receive that go above that flat rate get reimbursed. And it gets distributed back to the mutuals based on their portion of that. So it comes into RWC and then is dispersed back out to the mutuals.
So we just haven't dispersed it back out to the mutuals yet.
Right, it came towards the end of the month, so
Okay.
it's a big allocation.
Is that an annual?
Any other questions? If not, if we can move on. Ann?
Oh, thank you. Somebody's driving. Super, so the changes to this worksheet from the last time we met was after the board meeting and the approval of the construction phase budget for pickleball. We've put those numbers in there, so things are gonna look a little bit different in the sheet with regard to that. But generally moving through the list, starting at the top, so the payment program, the budget for that project was approved at 8/28, at the 8/28 board meeting, so we'll be moving forward with that probably at the end of the, I think it's in October. They also approved the event center flooring project, that is complete, we just finished that within the last couple of weeks. There's no activity on the fitness center roof replacement program. We have the skylight that we would like to replace and we need to work on some design. But we're hoping to get that started again by the end of the year. For the pickleball courts, again, we had that construction phase budget approved at the 8/28 board meeting, and we have our site development permit in hand. We had our pre-construction meeting at the city last week. And so you don't see anything for a while because there's lots of the coordination of the different players, the contractors, the subs, our team, to coordinate scheduling and whatnot. So that's a lot of the work that's happening right now. But we hope to be actively in construction towards the end of the month, or the middle of the month of October.
And the first step is moving the water line?
We're gonna coordinate and see the best way to do it. It could be concurrent with some other groundwork, because it's the same contractor now.
Yeah, that worked out well.
For the RWC admin relocation,
We're still working on sale of 1220 and potential acquisition of new property, so still in the works. Along with our representatives from Colliers and other consultants.
so the next project is the food and beverage capital projects, and so we have kind of a first culling down the pack of the four that submitted proposals next week. The consultants are leading that, and then the following Monday, we have the subcommittee, we have that date tentatively held to interview the two finalists. And then we'll proceed into contract, and that's where I wanted to point to the funding that's in here. It hasn't been approved yet by the board, and it's something that, based on what we negotiate in the contract and the work that we'll do to renovate the existing facility, we'd be coming back to the board for approval on funding for that. But we have that 500 placeholder in this year.
And
So you're using the consultants to analyze the RFP proposals, and then there's also a subcommittee that's gonna make the final decision. Who's on the subcommittee? What?
The subcommittee, it's a subcommittee of the planning, and the board president. So it's Leanne, Dwight, and Ted. Is that right?
I see.
Great. Okay, so for the next project, the Long Bowling Green turf conversion, part of what we did when we went to the board on 8/28 was talk about, deferring projects into next year, and that was one of them, so we wouldn't start on that until 2026. The same thing with the golf course lake liner replacement project. For NetSuite implementation, we all have various pieces of that puzzle sitting around the table, but actively, like kind of the new stuff that's being tilted up is my Rossmore and the implementation of Vermont systems. All those contracts were approved, so work is actively happening. For the golf bridge replacement, BKF is finalizing kind of construction details that are paired with various pre-engineered bridges, and so we hope to be able to bring concepts for the planning committee to take a look at and propose approval of for the golf course by the end of the year. And then the remainder of the projects are complete. I'm happy to answer any questions.
No questions? Okay, let's go on to MTF activity.
So the slowdown continues in the housing market. And again, this is not unique to Rossmore or really tell a story of anything going on in Rossmore. It's more reflective of the national real estate market. We'll see if anything adjusts with the interest rates coming down, if that increases activity. According to the real estate community, there is a good deal of inventory. It's just there's not the buyers out there actively. So we saw a number of 42 sales, 28 paying the fee. So we are down from last year. We'll continue to monitor. If there's any further questions or analysis of where we're at with that.
Tim?
So, sorry. So on the sale of this, I just want to make sure that we're looking at it correctly, and something to toss out there for you. Sold units were 4 ahead of last year, so maybe we're on track of what we should be doing. But income, we're down 13 units over last year. So I just want to make sure we're looking at this chart the right way. We always say we're going to sell 400, and this is all one big question. We're selling 400 a year. Should we be also add in the graph how many we actually sell and get MTF for?
The 400 is what we expect to get MTF for. So we're gonna sell more than 400 to get 400 MTF.
Have we ever gotten 400 MTF? I don't think
Yeah,
so.
last year I think we were 399, or we were and the year before we were 420. So yeah, we've been above the 400. Because we don't, in theory, we don't care how many we sell. All we care is how many get the fee. Don't care. Don't care.
The revenue.
I mean, obviously, we wanted the higher percentage, the better, but the 400 budgeted is for numbers of sales with MTF fees. Mary?
I have a clarifying question. Can we tell by looking at this information, how many of the units that were purchased for MTA were co-ops versus condominiums?
That's something we're working on.
Okay.
It's on the list. It is on the, I'm trying to get it by, actually trying to get it by mutual. something along that line.
Yeah, that's what you need.
Good.
Thank you.
It's on the list. I don't know where it is on the list, but it is on the list.
But in general, that rate of collection of the fees is caused by what? Like why certain units don't pay fees? Is there a high level explanation? I know we don't have the details.
Transfers between family members, basically. Or they are the only unit and they're buying a second. You can only pay fees once. So those are the two.
It's mainly somebody that is already a member
Yeah, yeah.
purchasing
So it could
the
be
property, or you could be transferring to the Waterford, or you could be moving to a different mutual.
Okay, thank you.
You know, again, we're trying to get a breakdown of that. That's also on the list.
So that right there, you can see where it's in the bottom, that's current members. So on the current members, there's a total of 9 exemptions. 5 of them are current members. You can see the previous paid parcel versus the new one they bought. So they've already paid once, so they're not getting charged a separate fee. And there were 4 that went into the trust.
Oh, I didn't see those numbers there. Good.
So
So
those are
you're
those
saying
9.
there's 9 total exemptions?
Yeah,
5 had a current member, so they bought a second unit or something, or they moved someplace, and then 4 that was
Oh.
transferred into a trust. That's your 9.
I see what it has, yeah, thanks.
Yeah, all right.
So I
And
think,
so we consider it a sale when somebody puts their unit into a trust, that goes into the sale numbers?
No, if a legal entity buys it, there's no membership.
Oh, I see. So that's not someone moving it into a personal trust. That is a legal entity purchasing rather than a person?
I bought mine in a trust and I paid the fee. So wait a minute, I want a refund. I want a refund.
but the bought a house.
I want a refund after
They
Kirk.
lived in it,
After they
created
lived,
the trust
yeah.
once
but-
they moved in.
Which is
After
what
they moved in,
I assumed it was,
Yeah, me
but
too.
Todd said he thinks it's a
It's a
corporate entity
corporate
buying.
It's when somebody has an existing unit and the title transfers from their name into a trust.
Trust.
So
Okay,
this reflects any time there is a title transfer.
okay. And that's considered a sale.
Yeah.
Got it. Okay.
All right. Yeah.
So about getting data, I know we had the issue about how much to increase the MTF fee coming up. And we've had various discussions about how the higher MTF fee affects sales and revenue.
that's a discussion we're gonna have.
So I think the main issue is that you don't really know because the lower priced items like the co-ops, probably the impact is significant because it's a large proportion, if it's 18,000, it's a large proportion of that value. And there's a lot of research which shows that we think in relative terms. So if it's a higher, like a 1.2 million sale, then 18,000 seems like chicken feed. So we need the breakdown in terms of the historical breakdown in terms of when we have raised the MTF fee, how much has the lower end gone up or how much has the higher end changed? That kind of variation in the prices relative to the MTF fee is, I think, critical information.
Well, we do see, the number of sales are exactly proportional to the number of units in each mutual over a period of time. It doesn't vary. It isn't like all of a sudden you see more high-end properties sell and less co-ops sell or something like that. 3,000 of the homes here are in co-ops. Roughly half of the sales are co-ops in any given month, in any given year.
It might start changing though, with the MTF fee going up significantly.
Well, it's on our list to try and get that, Harry. All right.
Yeah, to
Yeah,
get more.
To get more detail, yeah.
I just handed this out so people can see. I turned to my good friend, Fred.
Fred?
Yes, the Federal Reserve Bank of St. Louis, okay, which is, if you ever want economic data, just go to that. And this is a chart of California home inventories, homes for sale. And what's fascinating about it is that in 2022, it was down around 20,000, and now it's up around 80,000. It's just exploded over the last little while. And so that's what, so the fact that we're seeing a similar thing, it's not any different than what's happening in California overall. In fact, if anything, our inventory increase is actually be less than what we see in the general population.
Does he have one for Bay Area?
Or by zip code?
It might, I don't know.
Yeah, because
By zip
the
code.
low end areas in California are getting more people to move in.
Yeah,
Uh-huh.
you can go there and ask.
By zip code. Get our zip code.
Anything else under MTS?
All right.
Any NetSuite project update?
We will be going live October 1st with field service management that we've talked about. So that is the next, I don't know, I guess you'd say phase 2 piece. Obviously greatly affects you and his team and our ability to do all the work order setup. So that's that also from a financial standpoint is going to be the turning on purchase orders and all that kind of stuff. So that's happening here just in a short period of time. And hopefully we'll have all the bugs worked out before January 1st rolls around. That's our goal.
You're so optimistic.
Can you zoom out a little
It is.
bit? That's gonna be hard to see when we move to YouTube.
Huh?
If you can zoom one up so the numbers are a little bit bigger.
Oh, yeah, this is just on the budget. I haven't gone here yet, right? We're still.
Okay,
on the-
no update from the planning committee besides what we have, I'm assuming?
Well, you'll get their recommendation related to the MTF here in a few items.
All right, so I guess we'll go on the new business, the RWC operating budget for 2026.
Okay, this follows our workshops that we had, the joint workshops with the board and the finance committee in early September, where we reviewed all of the departmental elements of each RWC as well as RPM. It was an opportunity for staff to give a brief overview and answer questions about any specific line items within their budgets. The budget is based on the principles and primarily the principle that it is the same service level that we've been operating under. So you don't see a lot of spikes one way or the other because it is really, we're just increasing by kind of the cost increases. The service level that we're providing to the community for each department remains the same. The good news with this budget for the RWC is we have a year-over-year reduction in the RWC portion of the coupon. A large portion of that is due to the fact that the facility maintenance, the capital facility maintenance has been moved from the RWC operating over to the RWC capital fund. And we'll talk about that here in a minute in the next item. And then also the elimination of earthquake coverage, where last year we had 5 million in coverage for just the RWC property. That has been eliminated as well. So year over year, there is a savings up on the screen there. Since the workshops, we have done some revisions. The Comcast was adjusted down a little bit. They came in, we originally planned for their increase per the contract. They notified us after the meeting that there was a slight adjustment to their amount, so we made that. We took down the telephone line item within IT. There was an adjustment to the landscape turf maintenance within the RWC. And then we went and added in these two projects or proposals that were originally in the front of the binder, and from a straw vote, there was unanimous interest in adding these. So we took the liberty of putting these into the computation for your consideration still. And that is the Golf Pro Shop moving a 0.4 or 0.6 FTE, increasing it to full-time, so it's an additional 0.4. And then adding the digital marketing full-time position, which was a recommendation from the marketing task force. So those have now been kind of built in for your consideration. On the RPM side, there wasn't really any adjustments that came up during the budget workshop, so that remains pretty much the same. as was presented. The full accounting of this is still available on the Rossmore website if you'd like to see department by department, if you misplaced your binder. But we're here, we're happy to go through any specific departments or questions, overviews.
Yeah, one of my biggest questions was on the unallocated or the general services, the insurance number, the 203,750. The discussion was whether that was 12 months or 17 months, and I don't think we ever got a final answer on that.
So we did have a follow-up meeting with Adrian and Dwight and kind of went through the time flow of that. I'm gonna turn it over to Todd to answer that a little bit more, but hopefully we got that resolved, and Adrian can certainly chime in as well.
Chime in.
Or chime. Yeah, so Todd did a nice worksheet, spreadsheet that showed how the money was flowing. And the amount that's there now represents the 12 months expense. So it's actually good.
Yeah, you want me to go
So
ahead?
it's 12-month expense.
Yes,
So
it is the, yeah,
12 months.
it is the expense. Now, the one thing that is done here is that the expense that we're putting in there, correct me if I'm wrong here, Tom, expense that we're putting in here is essentially what we're spending today. So we're not assuming a reduction.
it's 130,000 less than the 20.
Yes, we're taking the number from last year, which was, no, so we're taking our actual expense from last year and projecting that forward for 12 months.
You want me to show my sheet?
Yeah, that'd be good, yeah.
So we're not counting on that 10% reduction in
No.
property tax for this.
So even though we have,
Yeah,
even though we have almost $300,000 savings in earthquake, we're only recognizing $130,000 savings. So we're assuming insurance is going up $155,000.
well, quite a few of them are, like the liability insurance is going up a lot. And
Yeah, so the budget,
gone up a bunch.
right, so the budget that we presented, right? We're gonna focus here just on property for a minute, right? All the other insurance have the expected increases that built in from our latest, information from Gallagher. So for example, general liability went up 20%, car went up, vehicle went up 15%. The property piece, which obviously is the single biggest component, right, is the one that we are still, right, it's still an unknown. They are giving us our best information saying, and if you look up here, obviously just on this model, all right, so for everyone, just kind of orient yourself. This is a calendar year, right? However, we have a new policy year, so that you can see that the colored bands on the top represent the policy year, right? And so we still have, where some of the confusion, I think, and probably even the way I spoke probably made the situation more confusing. Right now, if you were to have just a single checking account for property insurance, right? We budgeted in last year's coupon, $1,068,000, right? Our insurance came in at $950 or $118,000 surplus just on that one line item of property if it was all just flowing through one account. Okay, so in the budget, considering that we still have some very large unknowns, right? They are saying that we could see a 10% reduction, right, in this year, and that might be able to be maintained through the next policy year as well, okay? So these numbers right here just reflect those increases. However, we haven't actually seen the contract. We haven't seen what it actually is going to be bound at. So we don't know exactly what our 5-month extension will cost, nor do we know exactly what our new 12-month period will cost. So over here, everyone can orient itself. Up here is what we consider, this will be the accrued P&L. And so Dan and Adrian was saying, we're still only accruing a 12-month expense, right? So if you were to look at our coupon in 2025, that's in our current budget versus a hypothetical 10% reduction over what we paid last year, right? We were gonna generate a surplus or reserve, you could say, however you want to best look at it. Now, down here is the cash flow piece, all right? So P&L, income statement, cash piece. Once again, if we had a single checking account, we would take this surplus of 118, we would come in based on, depending on what we actually see come across, we would make a payment of $356,000 in January for the extension. If that same policy then is renewed basically for the same amount in June 25 through May of June of 26 through May of 27. So if you scroll over, we'll still have $1.2 million cash payment that needs to go out this year, right? On the current budgeted coupon of 168 or $142,000, right? Deficit between cash and what we actually have brought in terms of revenue, okay? So if you look at this cash balance for the end of the year, because we had that surplus carried forward, we're still negative cash at the end of the year, negative cash, right? We're positive on a P&L in terms of a surplus, but we're negative on cash. Now, the reality is we're still dealing with unknowns, right? So that could be eaten up quickly, very quickly. And then if you go down to the next year, you'll see the next year, keeping the coupon flat, and this is obviously a conversation we get into next year's budget. We'll actually know what those two contract amounts, we'll know more with right? It's always an ongoing thing. We no longer have the 2 months, the extension payment, we'll just have that one cash payment in June, right? You'll see from we're still gonna then go negative in cash for basically the first 4 months after that June payment's made. But it puts us in a healthier place to deal with any type of uncertainties, right? And like I said, I can't emphasize enough that we're just still don't know exactly what the 5-month extension and the new payment, the new contract will look like, right? So this keeps us in a very, I would say, much more comfortable, safe place. If you were to obviously reduce the coupon, you're gonna find that this cash balance gets negative quickly to the point where we're actually always underwater on the cash versus the budget piece. And so what we're recommending, obviously, what we talked about is that, and so just so, once again, the confusion was if I had put the same amount in for 17 months, I think I said, it was basically that the January 26th through May 27th would be the same amount per month, but it wouldn't ever been compressed into 1 year, right? So this is, you kind of have to have both hats here. There's a P&L effect, but there's also a cash effect, and we have other cash timing issues in terms of when these funds flow out with property tax and obviously everything else. So we're certainly recommending to the finance committee, like we did last at the budget workshop, that we're still dealing with unknowns. And so it's, we're coming in to basically say there's a couple $100,000 should be eaten up immediately if something goes south in the insurance market, right? So it behooves us to keep our coupon, not increase it, not reduce it, just keep it flat. We'll get through this extension, and then as we prepare the budget for 27, obviously we'll have a much better idea of the market in terms of what we can possibly do.
Yeah, Todd, thank you for putting that together. It really is helpful to see it on paper. And so if I'm understanding correctly, so the level of risk that we have on the balance sheet is estimating at this point about 150,000, right? And that doesn't include possible rate decreases or whatever. So that's not too bad, given that we have sufficient cash reserves always, right? So I was concerned before, like I didn't know the magnitude of it. 150,000 is not that bad.
And theoretically, as you go through this, because of how we pay, there would be half the months where we'd be in a negative position and then half the months where we'd be in a positive position, right? Cash wise. And that's what we would expect to see, because then another, the next payment comes up
And
and you're back in a negative
that
position
just shows up
again.
on the balance sheet.
That's right.
It shows up on the balance sheet as a prepaid insurance or accrued insurance. Okay, all right. Can we go back to any other questions on this? We go back to the budget page, please. Adrian, you want to bring up that other issue now, or is that later?
Now would be a good time,
Okay,
I think. The CPIU, Consumer Price Index, urban, is a measure of how much the cost of living has increased in our particular area. It's actually published for Northern California, or actually for the San Francisco Bay Area. And the compensation committee earlier this year saw it in April and June, and it was under 2% both times. And as a result, they recommended that we increase compensation for our employees by 2% per year. This has been our standard approach, to use the CPIU number as the basis for adjusting compensation. Recently, in August, they produced the most recent version of our RWC. And it shows that CPIU has jumped up to almost 2.5%. And if you look back on that chart, and I sent people a copy of it, it shows that, in fact, it's almost never been below 2%. Those two quarters, April and June, were actually anomalies in the last 5 or 10 years. So the concern that some of us on the board have is that the 2% is inadequate, and that we should increase the compensation by 2.5%. That will cost about $55,000 by my calculations, but I think, yeah, that's.
I think we have a little bit,
Good calculation, yeah,
Yeah.
so, on the RWC side, it would be, 55,729, so that's,
Per month.
No.
Per month for the total?
and then the
the year.
RPM side.
which is how much on the coupon?
75 cents.
55 cents. So the 371 favorable goes to 296 favorable,
Yeah.
give or take.
Now, it would also impact RPM's budget.
Yeah.
and that amount is 41,055 dollars.
And it would also impact workman's comp and some of those other numbers as well.
Yeah, so those numbers are salaries and the appropriate taxes and workers' comp.
So I
So
have a
that-
question. Go ahead.
So is the number you're giving us all in, then salary, workers' comp, all of it?
Correct.
Okay.
50
That's all in.
55.7. And what's the other one, 41?
41.
And we haven't fully settled with the union, I think we're still finalizing that, so there may be a little wiggle within that, how that works out, but we're using the same assumptions.
So, one clarification, but the RPM amount doesn't impact the coupon rate because it's self-funded by charging the mutuals, right?
Well, it
affects the
it affects the management fee, so in essence, it definitely affects what people are paying every month. It's just, are you paying it to RWC or are you paying it to your mutual?
So when I look at the RPM budget, 8A2 that was given to us, it shows salaries and wages expense going up by 2.7%. And so help me reconcile between the 2% that was recommended and 2.7 that's in here. And is that because of union stuff? Is that, I mean, I'm
Open position.
trying to understand that
Tackle that
piece.
one.
Sure, so each year there's a merit market pool and.
Okay, so it includes the
So-
merit, it's not just the COLA. Is that the short answer?
So we may have, at the end of the year, we recognize employees either that have fallen below the market, so we may have made adjustments to a job classification if it is now below the market. Or if we recognize an employee for outstanding service, we use that merit market to do that. And then that sometimes, if it's a percent increase rolls forward, there could be reclassifications of positions. We talked about a kind of a balancing between RWC and RPM with a few positions that we did this year. There may be a little variance within that. So there's a number of factors that can kind of drive that 2 to 2.7.
Which, okay, so the base for what Adrian brought up is 2, and that's where you ended up. Okay, I just wanted to make sure we weren't double counting or doing something else.
Yeah.
So, okay, thank you.
So just follow up on that, so that post adjustment you do, where does that money come from? Is it like out of the total budget?
So the board previously approved and is incorporated into this in 800. And
Okay.
previously approved an amount of 115,000 for RWC. So that's what we use to make all of those adjustments that then carry forward.
So I have 2 comments about this. I think that the CPI underestimates the actual cost of living, actually. A lot of studies which show that. And I think it's important to keep the wage competitive because it does increase turnover and morale, and also in terms of ultimate training costs and things like that, so.
So just a quick comment. One, thank you very much for bringing this up and considering the health of the employees and the workforce and retention. We have been extremely successful over the last 10 plus years. I think that we've been using this system where we rely on the CPIU for setting the increase and determining then annually what that would be. So the tradition is we look at the April number, the 12-month April number, and then that gets rolled into consideration by the comp committee into the budget, and then we build that forward. This year has been some anomalies. You've seen a pretty significant dip in the April, and then again, the July number was relatively down compared to what the trend was looking like leading up to that. So we want to be careful, definitely not to really stray one way or another from that formula that we've been using because it has been successful. But if you do look at kind of the numbers overall where they have been and now going back up again, it is a good recognition that we want to maintain the health of our workforce where we could be successful recruiting and retaining employees.
Okay, any other comments? So I guess procedurally, do we want to go back to approving the 2 separate motions? One this and then the add-on?
I would do it in 2 separate, yeah.
Okay, so can we go back to the overall budget page, Todd?
Yeah.
And does anyone want to make a motion that we accept the 1, 2, 3, 4, 5 adjustments to the budget for the meeting, or however you want to word it, and recommend to the RWC board that we accept this? Do I hear a motion from anyone? Okay,
I'll move. I move that we recommend to the RWC board the 5 increases or the increases, 5 changes as noted.
To what?
To the budget,
RWC.
budget, right?
is there a second?
Harvey.
Any further discussion? If not, can we have a roll call vote, please?
Certainly Rings,
Yes.
Star,
Yes.
Castillo,
Yes.
Hines,
Yes.
Jennings,
Yes.
Singh,
Yes.
and Byram.
Yes.
It's unanimous.
Okay,
And then your next would be a recommendation to amend the budget by adding the
okay, do anyone want to make a motion for that? Okay,
Go ahead and make that. I move that the finance committee recommend to the board that they alter the compensation adjustment for all employees, both RWC and RPM, from 2% to 2.5%.
and should we, and the impact of that would be approximately $100,000? Or do we care? Do we?
I think we just stated it that way.
Okay.
And then
All right. Is there a second?
Second.
Any further discussion? Seeing none, roll call vote, please.
Certainly Ring,
Yes.
Star,
Yes.
Castillo,
Yes.
Hines,
Yes.
Jennings,
Yes.
Singh,
Yes.
and Byram.
yes,
It's unanimous.
Now we gotta go to RPM.
So the RPM portion of this, we did not have any changes after the budget workshops. This is the budget then that we will use to incorporate the management fee into the services we offer to the participating mutuals. So this is a critical component for developing the mutual portion of the mutuals budgets. We're have Jeroen here and happy to answer any questions regarding the management fee or the various departments that make up the property management division. We are looking for a recommendation to the board to approve as presented.
Any questions on RPM budget? If not, anyone want to make a motion to recommend? Go ahead, Cheryl.
I recommend that we approve, as presented, recommend to the board that we approve the RPM budget as presented.
Any second?
second,
Any further discussion? Seeing no further discussion, roll call vote, please.
Certainly Ring,
Yes.
Star,
Yes.
Castillo,
Yes.
Hines,
Yes.
Jennings,
Yes.
Singh,
Yes.
and Byram.
yes.
It's unanimous.
Okay, budget's done.
Don't we have to amend that one too?
No, his vote.
Oh, never mind, sorry.
Motion amended vote.
Got it.
He was
Thank you.
proactive.
He is.
Okay, next on new business is the considered to increase the MTF based upon funding needs amended for the 10-year capital project.
I know.
Okay, you can all put on your magnifying glasses and we'll.
Yeah, that's really.
Okay, so this very first exhibit that you're looking at, let me go through this because this is kind of the base where we're our starting point. There are a number of assumptions in here that have not been approved. We only approve the current year budget. So everything beyond 2025 is an assumption, subject to change. But what we have done is look at a 10-year window, really to try and determine what resources we will need in order to carry out not only our base improvements, ongoing maintenance and upkeep of our capital assets, equipment and machinery, and so forth. So just to go through our starting point here. Every year we have capital expenses for maintenance, rehab, replacement. The main driver of that is our pavement program. We have put in $1.5 million and then escalated that by 5% a year. So that's kind of across the top here, your first line that you see. Every year we have a machinery and equipment budget around 700,000. So we have started that first year 2026 is 733, and then we've escalated that by 5% a year to maintain those resources. The pickleball, you see, this was discussed last time, where we have funding based on the approved overall construction phase budget in 25 and carrying that into 26. That is the same amount that has already been approved. The food and beverage, again, this is, as Ann mentioned, this is pending the final agreement with a new vendor, and these are resources to do some refurbishment. These haven't been approved yet. We'll be bringing that to you once we have a new contract for your consideration. We have been talking about the lawn bowling turf conversion and what we're gonna do up there. That's been moved to 26, 27. Golf course lake liner is another one that is in the works. So we put in the funding into 28 for actual work. We'll complete the study next year. And then there's other major projects where we haven't completely defined them yet. We do have a separate worksheet that we refer to that has all of our assets. So it's something that we use to help develop this portion of the budget on an annual basis, where we have things like the pool plasters, the entry gate upkeep, pumps, and various things that we know we're gonna have to do to maintain our existing infrastructure. And so we budgeted, again, $1 million a year escalated out for those types of projects that are ongoing. So that is really, and then next year there's been consideration, again, hasn't been approved yet, for water conservation projects and to do some dollar rehab projects. Those will come back for final consideration. So this top line really reflects what it takes to maintain our existing infrastructure as well as address kind of existing projects. Based on the action during the budget process, the RWC facility and property maintenance formerly in the operating budget has now been moved to the capital fund. So we start with a balance next year. Again, this needs to be refined based on the actual projects that will go into it, but we put 850 in here and then escalate that by 5% a year. So that's the new item there in pink. If you drop all the way down, the other item in pink, down under revenue, there's a transfer of the trust maintenance expense operating fund balance. So we're moving over the 485,950 that was in the trust fund reserve. That's a one-time kind of thing. If there is a ongoing operating surplus, those resources could be considered for adding to this line here on an annual basis after we do our completed audit. Then what you see here, so based on this alone, down at the bottom, we have the 14,000 for the MTF for next year. That's what is currently scheduled to be. And then going up 500 a year. We're still projecting 400 sales on average. We know this year may come in a little lower, but we're sticking with the 14 for this discussion. You will see that pretty much right off the bat, we're lower than our $2 million kind of target cash available. And in 27, we drop down to 132. In 28, we actually go negative and fall by 817,000. So maintaining the MTF at 14,000 pretty much right from the beginning without doing any new projects generates a negative balance in the capital fund. Then if you look over to the right, when we did the facilities master plan, there was a number of projects that was generated that were put on either a long-term project list or a wish list. Many of these have already fallen off and aren't really around for consideration, but I listed all of them and I listed them in 2022 dollar amounts as well. So you see things like dollar exterior accessibility for the patio and the ramps leading into the clubhouse, hillside pool building replacement, new MOD offices. That was seen as the #1 project when the facility master plan was done. Pretty much a full renovation of Dollar Clubhouse at $8 million. And the list goes on. Again, not all of these are even up for consideration anymore. So if we can go to the next attachment there.
So why are they not in consideration anymore?
Some like the water reclamation facility. We did a number of studies, but we moved more towards a place where we would look towards joint advocacy for recycled water.
So I have a question before we move on. So one of your basic assumptions in this spreadsheet is that existing debt service remains at 2 million every year.
That's going down.
And when I look at how our debt service matures, it looks like it should go down. So does this assume that we're going to have additional loans that replace that? What's going away in
Yes,
order
thank
to
you.
stay at the 2 million?
Yeah,
How
thank
does
you for bringing
work?
that up. So as I start to populate some of this for illustrative purposes, one of the projects, the kind of the main project, the new MOD offices at 13 million, that project, we will not be kind of including in this from a perspective of that one involves the sale of the existing medical center property, which would generate revenue, which again is not included in this. And it would also involve the refinancing of our existing loans. So you would have a new overall takeout loan. So the goal with that project is that it would be neutral to our cash flow model here, other than you would see the existing debt service remain flat. What that ultimately is, this is just making an assumption for this discussion purposes. Can I answer that at all?
Does it assume that the sale of a building, the purchase of the new one is a cash neutral impact? Or is there going to generate cash to afford some of the remodeling, all the remodeling, or none of the remodeling?
It would
Do you have any
afford
ideas?
some of the remodeling, and then you would have a new takeout loan that would fund the rest of that.
Do you know how large percentage?
That's what's in the works right now. Yeah, we don't have that answer. So that's why I put it kind of continuing at the same level, knowing that, yes, we would have in 27, the first loan paid off, and otherwise these would start to, tail off. But this assumption is that we would have a new takeout loan, and it would be fairly equivalent to what our 2026 amount of debt service is.
So can I,
Yeah.
can I ask an overarching question about infrastructure? So the sense I get from this narration is that there seems to be quite a bit of deferred maintenance in terms of infrastructure because of the fact that the capital budget has limited resources. Is that a fair statement, you think?
No, I don't think so. We budget every year a significant amount for ongoing maintenance, and that's a high priority when we present and the committee considers the capital budget is maintenance of our existing infrastructure. So no, I wouldn't say we have a lot of deferred maintenance, especially on the RWC side at all.
I mean, we budget like $2.5 million.
Yeah,
For capital maintenance and machinery. So,
So this next slide shows kind of the exact same model, but with the MTF going up to 18,000, and then you continue the annual increase of 500. And you can see by taking that move, what it does to the available cash at the bottom, where we start to significantly increase over our target amount of $2 million. Okay, so this puts us then in a position where we could start to afford some of these projects that are on the facilities master plan list.
That makes one huge assumption, which no one knows if it's right or wrong.
Yeah.
There's no impact on sales.
Right.
I did call, I have a couple of realtor friends, I called them. One of them said was at a meeting with 25, 30 realtors when this came up. And their reaction was, what are they thinking? Are they nuts? That's a quote.
And I was there because I was presenting it, so I can tell you.
So I'm just very worried that, especially on the lower end, if we go to from 13.5 to 18, our sales are gonna go from 400 to some number significantly less. And then I don't care if we're gonna have to start charging $1 million a sale, because the number is just gonna fall off the face of the earth. And I'm basing that on no facts, because no one knows, no one knows what's gonna happen. I realize
Yeah,
that.
let's talk about that a little bit, because that is an important factor, is where is the line where the fee will start to impact sales? And when I did present that to the realty group, there was several that went, oh, there's people right now at Safeway that can't afford to choose what they're going to afford. When we went back and started the whole marketing initiative, the purpose of that was really to say, what is Rossmore? Is Rossmore affordable senior living, or is Rossmore a, excuse the expression, premier active adult community? And because you can't in these days really be both. And that's a tough discussion to have. We know that on an annual basis, the coupon is going to continue to rise. So the question I had for the realtors is, what is more important? Is it the one-time kind of initiation buy-in, part of your closing cost more or less fee, or consideration of what is the coupon doing? What is that escalation? And they all said it's the coupon is where their focus is. Then I asked, what is kind of the value of the amenities when you go to sell a property? When you're looking at the fact that we have updated, well-maintained property, amenities, we have a new pickleball complex coming on. What is the value of that compared to if you consider deferred maintenance or lack of new amenities that we're keeping up with over time? The value of having those well-kept amenities outpaces certainly their ability to sell a membership transfer fee at $18,000. Also, you can finance for up to 7 years that membership transfer fee. So is 18,000 a deterrent when you want to keep in mind that we want to attract a fairly financially stable new resident group? We don't want to be bringing in new residents that can afford the purchase, but then 2 years later, when the coupon goes up 5% a year, 10%, they can't afford it. You want to make sure that the folks that are coming in can't afford it. And the reaction from some of the realtors was, how could they afford groceries? Well, I don't mean to sound cold, and don't quote me on this in the paper, but this isn't low-income housing. It's not low-income housing.
I'd like to talk a little bit about what Jeff said there and put it in a context. If you look at, if you're a person of 60, 65, whatever, looking to move into a retirement community, what are your options in Northern California? There's Rossmore. It's about the only one that's actually in what you would call the San Francisco Bay Area.
Yes, that's true.
I mean, there's the villages down way south in San Jose, but, you know, if you've got kids in Berkeley or San Francisco or Pleasanton or any place like that, this is the only location where you can buy. The alternatives are in Tracy, or they're in
Brentwood.
Brentwood. It's the closest one.
Yeah, Brentwood, yeah, because I looked at all those when I came in 3
Yeah,
years
and
ago.
they're further out, right? And if you look at the prices of the ones out there, I think they're in the $500,000 to $600,000 or $800,000.
They're much cheaper. We're here, when I looked 3 or 4 years ago when I came in, 4 years ago, this was by far, first of all, you're right, it was the only, my son was living in Oakland.
Yeah.
So it was the only one that made a logistic sense,
Mhm.
but it was by far the most expensive place to buy. By at least 100, but you got, the costs were about the same, but you got a 800 square feet versus 1,800 to 2,000 square feet.
Yeah.
So per square foot, it was different. The total cost was about the same.
Yes, but my point being that if you are interested in being in the Bay Area.
Yeah.
Then it ain't cheap. This is not the place to retire to if you are looking to save money and all the rest of it. I mean, that's just not the reality of it. And so what we're providing here is essentially a country club. I mean, golf courses, swimming pool, fitness center, ceramic studio, woodwork shop, all of these various things. And they're the same whether you buy the lowest priced unit here or the highest priced unit. It has nothing to do with that. You're buying a chunk of the amenities, and that's costing $18,000. It's a pretty good value if you compare it to buying into any kind of country club. And so it is a matter of how do you present it to people. If you present it as, oh, you're buying a house for 400 grand and it's 18 grand on top of it, then that's one way of looking at it. But if you look at it from the perspective of saying, you're buying a membership in a very nice country club, in a great location, I don't think it's going to affect sales.
So a couple of things, I think all these are good points, I don't dispute them. But I think there's a lot of uncertainty we are not sure about, particularly how the real estate market is going to be in the next couple of years. So that 400 sales, I think is optimistic at this point in terms of where the market might be going. And then there's that argument in terms of time series, but there's this other argument in terms of cross-section. I mean, like Laguna Woods, the MTX is about 7,000. Of course, we might have more facilities and stuff like that and might merit a higher amount. But I think my main point is that we should be cautious in terms of always hitting the same nail because that's the only nail we have. That's the only hammer we have. So, I think in the last meeting, we did the calculation that when we moved the capital operating expenditure in there, 16,000 would make it budget neutral, right? So raising it to 16,000 and then incrementally increasing to 18,000 in the out years, if that kind of stuff which Jeff is talking about in terms of the new Rossmore webpage and marketing and stuff like that, and the total value proposition which we're trying to make is most successful, then we might have an optimistic scenario. But at this point, I don't really know.
Before we continue, can you throw up the last slide, the last one there?
So Jeff, is this the,
No, the one where I have some of the projects spread.
It's 8B5.
8B5?
Yeah.
Is that what you're looking at?
There's 86 too.
I didn't get an 86.
8B5 is this one, right?
Oh, at the top, it's how it shows in the corner. It's 8B4. So maybe
It's
the
down
next
below.
one.
This one has,
85.
This one has,
Maybe the page.
Yeah,
this
that's
one
even
on the-
Yeah,
the
that's
bottom.
what I
I wrote
got.
6.
Yeah, I think
It's
that
really-
it's 5.
Yeah, it's 5, right?
It's really
Yeah.
5.
Okay,
That one.
there was no 6.
I thought 2.
Yeah, go back to the main report and then you can open up the last attachment.
This one. This 10-year 8B. Yep. And then this one, this is the one who, 8B5.
So before we get into the discussion of, should it be 18 or should it be 16? So we talked about if it stays at 14, you see we go upside down fairly quickly.
Can you make that bigger, top, please?
I know, I'm sorry about that. When you're trying to spread 10.
Yeah, no.
It's like-
You lose.
But so what I did was I took a number of these, again, this is just arbitrary. I made a lot of assumptions, but if you took the dollar accessibility, so redoing the back patio, the ramps in, this is a project that's been around. We put it at 210,000 because we escalated. If you take, slide over a little bit there. So I start to populate a number of these, and I didn't do it at full renovation, say $1. Instead, what I did was, what if we spent 500,000 and then a million, 500,000? We do significant renovations, but you're not doing a full tear down rebuild kind of deal. You see still, then slide up a bit. No, the other way. At 18,000, if you start to populate those projects, which the community is clamoring for, and we have to maintain those we have Hillside, 1964 build. We have the Dollar, 1933 build. They need attention, right?
Can't go there.
So if you start to add all of those kinds of projects in, you're looking at, basically, you're maintaining your $2 million target at 18,000. So if you drop that to 16, you will not, we'll be back here having this same conversation fairly quickly.
But what if that 18,000 has a 10% impact? So it goes to, instead of 400, it goes to, put it in 360 units instead of 400. 10% impact is not significant. You're gonna be in the same spot either way.
Yeah, but I disagree that you would ever, because what would happen is the homes will be there for sale. The price of the home will adjust so that it sells. The number of sales we have is dependent on the demographics of our population. I mean, the reality of it is that people are going to live here for approximately 15 years, and then they're going to die.
But you're assuming someone wants to buy it. If no one wants to buy the unit, they're gonna.
No, the market always adjusts. Supply and demand match, and the price is where it falls. And so what might happen is that because of the price of this increase, what you might see is that instead of selling a home for $500,000, you only get $450 for it.
Or maybe you lease it out and you don't sell it because you can't afford to take that hit. So therefore your sales your lease rental goes up, but your sales go down.
That's
That's what's happening now.
But then the FUF kicks in.
But that's operation. That's what's happening now. Our FUF revenue is going way up because our sales are going down. People aren't getting what they want, so they're not selling. I'd like to see that go down to 360, and I think you're in the same spot at 360.
But if it goes down to 360 and you only collect 14 or 16.
But I'm saying 360 at 18 versus 400 at 16 is about the same number.
Make it be a wash.
I think you're making assumptions that
I am making assumptions, but you are too. You are too. I'm just making different assumptions.
Yeah. Just a couple of things I wanted to say that insofar as there might be an impact by raising the MTF, we do have in place this marketing initiative, right, which is a mitigating influence. We're communicating more of what we are, what kind of cost to expect, what kind of place that this is. Although, I mean, we're making an assumption that that's going to work. Right, but I mean, that has to be taken into the equation. And just the other comment is I got a notification from Redfin app about prices of things sold the other day, and there was a unit that was for sale for $269,000. So we have one unit at 269, and then another one that was 2 million. So to say we want to be a premier community, which I don't, exactly know what that means, we still have units that are out there that are 269,000, which does not qualify for premier or premier customer, anything like that. So, to continue to be able to either sell those places or fix them up, or I don't know what they are, but
Well, I think-
that has to be taken into account.
I think what Jeff is saying in terms of premier community is the facilities and the other kinds of stuff we provide here in terms of amenities. But I think go back to what Dan is saying. There's a lot of uncertainty. We are making a lot of assumptions which we're not sure about. And a prudent business decision in the face of uncertainty is to be cautious and incremental. And I'm not saying, I'm not disputing the need. The need is there. But the question is, our source is only one, in terms of meeting the need. So I would be in favor of, increasing 18,000 down the road in 1-2 years. If we see whether our marketing, initiative is succeeding and how the market conditions are in terms of real estate sales and stuff, why make the full decision right now?
So I have a suggestion, maybe. I'm a little bit worried about jumping it from the 13.5 to 18. I think that's a little bit of sticker shock for the market, and I think that seeing the inventory of Fred, the information that you brought, that's a concern. I think the sales, it could dramatically impact sales. We know that we're covered at the 16. What if we went to like 16.5 and instead of jumping by this ridiculous $500 a pop, take it up $1,000? I mean, that mitigates it a little bit.
I was saying the same things if I was saying start at 16 and go up 1,000 a pop. By the way, the difference between 360 at 18 and is $80,000.
Yeah,
So that's a big risk to take
I agree.
for $80,000, if it has any impact at all. So
So something like 16 with 1,000 increase every year is, I think, incremental.
So the one thing that I want to rely on, I guess, is the fact that the planning committee really studied this. We didn't. And they've made a recommendation based on their, and I know we're not, and I do not say we should just do what they say. Our job is to be critical and to think about it. But I'm not sure that I have all the information that maybe the planning committee went through, and maybe to hear a little bit more from Adrian about that and how they arrived at the 18 would help me in making, a decision about, where it was, and maybe, Jeff can add into that as well. But, as I sit here, we're just throwing out numbers. Right? And, well, what about this? What about that? So maybe a little more background would be helpful.
I mean, I guess the question is this what they had, or did they have additional information?
Ted?
So in the marketing task force meeting, we looked into this a little bit, but when you're talking about money to buy into a place, is it a question?
Yeah.
Could you consider
What is?
and then say what you want to say?
It was considered that the 18,000 per year, but our competitor, like a CCRC unit, which a lot of people are moving into, they are 50,000 to 500,000 buy-in that you don't get anymore. You don't get
What is a CCRC
Yeah,
unit?
that's
That's
your
a
point.
continuing living retirement community where you have amenities to do, but if you get sick, you can move to a different level.
Levels of.
They're building one on Ignacio Valley
They
Ridge.
are a competition of ours. So I
Yeah.
just put that out, the money.
It's a different product though.
Yeah.
Yeah, what do you get for that? What do you get for that 500,000?
Sure.
Lifetime care.
Lifetime care.
Yeah.
So back,
Lifetime care.
But you still pay for it along the way. I have a friend who just looked into this. There's one that they're building out on Ignacio Valley Road.
Yeah, exactly, yeah.
And she just did the tour and everything. The units are starting much, much higher. And the monthly cost is 3 to 6 times right now, even though she doesn't need that care, 3 to 6 times what we charge. And she's gonna pay that until she needs that care and more. So their whole cost structure is completely different, and you are paying upfront in, the monthly amounts.
Okay, can we hear from the?
to go back to
Yeah,
your
planning.
question, the planning committee looked at the same types of spreadsheets. We talked a little bit more about the list of potential capital items from the facilities master plan that will be considered over the next 10+ years. So when you look at the impact of adding those, as you see in this current spreadsheet, what is the resources needed in order to accomplish that? And then kind of going back to, should it be 14, 16, 18? If, and this is part of the discussion with the realty group, if a buyer is interested in Rossmore, is the difference between 16,000 and 18,000 going to deter them from proceeding with the purchase in Rossmore? Are you going to look towards another property because of 16 to 18,000 initial buy-in?
I think it depends, I think it really depends, because I've only been here for 3 years. And I've sold a big house, with a lot of money. So when I looked here to get closer to my kids, my grandkids, they said, take a look at Rossmore. And so they said, find a real estate agent. I did. And then they said, what are you looking for? Well, I'm saying, well, what's your price limit? And I said, well, up here, way up here. And so my question really is, there's like two kinds of homes here. The ones that are pretty expensive, and I mean like from 800 up to 2 million. And those kind of people probably had so much money that, going from wherever they've sold, it's not a problem. They're gonna put more money in the bank when they come in here. Even though the bank buy one for $1.5 million, they still put money in the bank because they sold one for $2.5 million. But who are the people that buy into the 400,000 level and the 300,000 and the 500,000? And what's the money that they had to sell to move into Rossmore?
I moved out of state, so I came from Midwest.
Yeah.
I had a unit that was twice as big as what I have now. I had a little condo, and I paid 3 times what I sold that unit for. So I downsized the square footage and tripled what I paid for it.
Now, a lot of people do that, make that decision?
Well, there's only 4 or 5 of us who move into California every year. So you only gotta worry about the 4 or 5 of us because everyone seems to be moving out.
And definitely the reverse commute.
Yeah. So if you come in from a state besides New York, California, some of those big states, you have, unless you have a huge house, you have that issue. I mean, I was cash poor. I had stuff I didn't want to sell, but
So I just don't know.
18,000 would have been, between 16 and 18, Jeff, probably no difference. But between 10 and 18 or 12 and 18, I would have looked long and hard, but the only thing that it has is what Adrian said. My son was in Oakland. When I moved to Brentwood, which is where I really wanted to go, I might as well have stayed in Missouri because the commute would have just been terrible. Now, realistically, he's now since moved into Pleasanton. So I could have been in San Jose or Brentwood have been the same distance, but I didn't know that. And he didn't know that. So if he had bought in Pleasanton and I was looking, I would not have lived in Rossmore. It's too expensive. Because it is. But I'm the minority. Most people do what David says, I think. If you look at most of them
And
in
the
here.
reality of it is, where can you buy a house in San Francisco Bay Area for $400,000 or
I know what my son,
$500,000.
I know what my son paid, I know what my son paid in Pleasanton, I cringe.
But you've got to drive another hour.
For what he got, right?
That's
Cringe
right.
of what he paid for what he got, that house was
So I
in
think
St.
there's-
Louis, it was $400,000 that he paid.
There's another thing I think to consider, and Jeff really touched on this, was the idea of helping to keep the coupon down and, you know, all those other things. I know we're talking about the facilities, but once you're maintaining those facilities and the other costs that you have, we just had a recent get-together for our entry, and people were talking about this because it's been in the newspaper and, you know, and people were more concerned about their coupon going up. And the comment that was made was, if I could have paid more in my transfer fee and financed it and kept my coupon down, I would have done that in a flash. And that was, you know, kind of the comment. And it's also the comment of, well, I moved in here because the facilities were great, and that has value to me. So, you know, there are views all over the place, right? And that's the thing that,
But if 10% of those are gonna be financed, then we gotta take the 400 down to 360 and take 40 divided by 18, over 7 years. So I think the financing is
still
great,
just
but it's still, it doesn't help us in this situation because it moves the money out.
I just want to say, can I just say one thing? I just have to be quiet. I think the only question here is whether or not raising a fee correlates to reduced sales. Right, that's it. If it doesn't, we're leaving money on the table, right? Everyone agree to that? So then the question is, does it really impact sales? And then we also have to take our hats off where we live here and say we're looking at an increase. But if you're a first-time buyer and you don't know the 13,000, and you're saying I'm paying 18,
But you do know,
right? Well,
you know what it was a
that's
year
fine,
ago.
but to Jeff's point, there's $2,000, you know, and Kim just said, have you ever met anyone that says, I did not move into Rossmore because it went from $13,000 transfer fee and I just couldn't afford it? I don't bet anyone has not ever said no to a sale because of the transfer
We
fee.
wouldn't know them because they didn't move in. We wouldn't know because they didn't move in.
Our real estate agent didn't tell us about it.
Our sales are-
We said, oh, we'll buy it. And they said, oh, by the way, there's another 10,000 that you paid just to move
Exactly.
in. They didn't make that clear to me.
So right,
I never knew it was financeable.
right now, the
I didn't know it was financeable
it's
either.
in the
So
paperwork.
right now, we're
The
at
paperwork.
256 fee generating transfers this year, all right? That's $770,000 if we had it at 18 in the beginning of the year, right? So would this 256 be 200? No, it probably would not be.
I think it's more than that, Todd. I think it's a message that it sends to everybody that all of a sudden, we are, and a word that I was told the other day, are desperate enough that we have to go from 13,500 to 18,000.
Such a huge jump.
It's such a huge jump that it's talks of desperation. The question was, are we financially okay? Why do we have to do this? Why are we going up? What is that, 25%?
What was your response to that?
I said, we are financially secure. I said, we have done a couple things. We moved things out of the operations into the trust. And that in order to keep the coupon lower. And I said, I'm not in favor of the 18,000, but I did say we're financially secure because we are. But it does speak of desperation in my mind.
I think it also speaks to capital improvements. It speaks to a new pickleball court. It speaks to facility enhancements in a 60-year-old community.
Which the problem with that is half the people half the people here think the pickleball court should not have been built.
But even if they weren't, you still would, this community is built on the concept of having those amenities. Is built on the concept of having those. The second this community starts to feel tired, starts to feel like it's not well maintained or updated or vibrant, your sales will plummet
Agree 100%.
significantly.
Agree 100%.
So again, if you're talking about, you know, the cost these days to construct, to maintain, I mean, who would have ever thought that pickleball would cost that much for those courts. Who would have ever thought that, to do some of these projects that we're talking about cost what they cost, but that is the market we are in. We are not in a place where construction is significantly less. So in order to keep that up and be able to maintain what we're doing, it's kind of the cost of doing business.
And also, it's like now we have the pickleball court that half the people don't like. But when it's their turn, right, because those people, when Dollar Clubhouse gets renovated or Hillside, so that if we're fairly allocating, that, and all of the facilities are improving and serving our needs and up to date and all of that, just that should be part of the message. It's just, we didn't just, capitulate to the pickleball community. We are looking at this on an overall basis so that everybody is happy and their needs are served.
Mary?
I have to echo John, Danny, I have a clarifying question. To whom is the message about the increase in the MPF directed? Is it the people who live here or the people who live right here?
Both. Both, because if it impacts your selling price, if people think it in fact impacts your market value and your future selling price, you gotta get that message to them.
Yeah, but it does,
It's both.
it does affect, it does affect your
Yeah.
selling price. Absolutely.
Yeah.
It pushes it up.
Yeah.
Because if you have better amenities here, more attractive, then there will be more demand for the homes and there will be a higher price for those homes. It will not reduce value in your sale.
So the marketing task force did a survey of 250 residents that had moved in within 1 year's time that we did the survey a year ago. I just want to give you a little sense of the folks that were coming in. So overwhelmingly, amenities was the #1 reason that they moved here. Second was proximity to family. Third was low maintenance lifestyle. When we asked them about things that were a concern, reasons they may not have moved here, the MTF out of 15 was 12. So it was not a huge factor for the 250 people who moved here. Here's the thing that I actually thought was interesting. The community facility maintenance, when we're asking what's important to you in moving here, what are you willing to pay for, was #4 on their list. So that is having the facilities kept up to date, at least to the 250 that moved in, it's important. So maybe part of this is about explaining what that MTF fee does. Maybe we need to, going back to the marketing end of this, we need to explain, even to the folks coming in, this is what your maintenance fee is going towards, instead of just saying, surprising everybody and saying, hey, by the way, you have to pay an extra this much money. If they know what they're paying for, then they're making kind of a decision, a reason as to whether or not that's worth it to them.
That's a good point. So can you go back to the statement you made about the MTF was the 12 in their consideration?
Yeah,
What was the question?
So the question that was asked, what things impacted your decision to move here and might have caused you not to move into Rossmore? And there was all sorts of different things. The coupon was the #1. What people are paying on a monthly basis was #1. Proximity to family, if, like some of them were talking about how some of their family are in San Francisco, so they're still a little bit further away. They talked about the aging infrastructure, so that is a concern in here. But in this list, there were 15 options and MTF was #12. So that fee was #12. #3 was, this is kind of interesting. They didn't like the fact that Comcast was built into their coupon price.
They wanted their own cable.
That's such a good deal.
I know.
That's a very reliable survey.
I know. And there's concerns about what they're talking about, utilities, the pipes and the electricity being older. Some folks were actually concerned by the gate. That was pretty low, actually. The issues with transportation, with the bus service now having been impacted, the weekend when that came up, that was #6. Oh, let's see here. You said other services. I don't know what that meant, because I can't see the full breakout on this.
Can you correlate that survey responses to the level of house they were buying, like the size of the house buying?
Well, we could break it down. I could tell you where they live if I broke down the results further. But it was interesting.
Versus co-op.
Yeah, number 6 on the list was the mutual that they were looking at. They didn't want to be in that mutual. So they ended up selecting a different mutual.
If you study, if you go back through the board minutes and all that stuff.
Oh, my goodness.
I think real estate agents.
It's interesting, though.
steer.
Well, I mean, the other thing is, as painful as this discussion is to have on a regular basis, just because we're doing something here today doesn't mean we can't change it in a year. So I don't want to lose sight of the fact that if it warrants it, we could increase it again next year.
I would support something like 16,000 and 1,000 increment every year. And we can revisit it in the future and see how it goes. But otherwise, it's built in anyway.
So if we were to do 1,000 a year, that would take us.
Jeff, can you run the number?
Yeah, can you put the numbers
Put the
in?
numbers in, or Todd, can you put the numbers in and see what you
In the middle of doing it.
Oh, it's a PDF, it's a PDF.
Would love to.
Oh, I thought you
What would you like to do?
put in 16,000 with 1,000 increment
Just caution.
instead of the 18,000?
Well, and also, could you articulate, Jeff, the argument for doing it up to the 18,000? What are the benefits of that, of an immediate jump to that level?
Okay, so if you look at your 10-year funding model with, scroll down a little bit, with some of those projects populated, or you're starting to, over the next 5, 6, 10 years, address dollar. This isn't next week or next year. This is, you're talking up to 10 years out for those facilities that are ready for something. At 18, you start to build your cash balance, maintaining at least the $2 million cash balance, and you can address those projects.
Can you go farther down to the right?
So you're funding things like ongoing maintenance at dollar. It's not a full rebuild. You're doing something by the end. I have 8 million at Hillside. That's certainly not a full rebuild by any stretch of the imagination, but that's a significant, but that's all the way into 34, 35. And if you look at the cash balance at the bottom, you're at 2.9, 2.1, 2.2. So those are the resources that you would need to complete that level of improvement over the next 10 years.
And can you change that to 16,000 with $5,000 increments?
It also assumes that we're
Just to-
never
just to see.
increasing it.
So I was sitting here doing some math while all this was going on. So
That's why you were quiet.
it's true, that's why I was quiet. So what he has put together is 18,000 going up $500 a year. And so what I did is I just multiplied that out. I accumulated year by year. I'm trying to come up with a break-even point, right? So if we go to 16 and then go up $1,000 a year after that, so it goes 16, 17, 18, 19, 20. The break-even point is in 2030. So it takes 5 years for us to hit a break-even point.
Break even meaning that the two numbers are
To going, just comparing them.
Yeah, okay.
So cumulatively, under starting at 16, going 17, 18, 19, 20, 21, 22, in 2030, we will have raised 16.4 million. And doing the 18, 5, 19, 5, in that same year, we would have done 16.2.
And then if you run it out to 35, which is the end of it.
I ran it out to 38. And in 38, by the time okay, so I can stop at 35 if you want.
Because that's what,
So starting at 16, going up 1,000 every year, we will have collected 20,400,000 under the go to 16, but going up 1,000 every year, not 500. versus the 18 going up 500, by the time we get to 2035, we will have collected 18.2 million. So doing
2
this
million.
18.2, so there's $2 million more available by 35. If we start at 16, but go up 1,000, that's why that works, right? It's
Yeah,
not going up
your
to 15.
incremental,
I agree.
Right.
So, you know, there is a fairly short break even. I don't know what the projects are in the next 5 years we're trying to finance. There is this idea that we're gonna go negative sooner if we, you know, start at the 16. That's,
So I think that's a good long-term perspective. I think the point Dan raised initially, I think earlier is interesting. So when I try to buy into a property, I try to figure out, we looked at villages and we looked at Brentwood too. And we looked at their finances and stuff. We try to figure out whether their financials are stable or is there some kind of an issue. So when I see a jump of
You need that thing.
significant amount,
Do you want me to go?
that sends a negative signal to me
sure.
in terms of the instability of the finances. And if I see incremental increases, you're just funding the long-term liability with this incremental increases. So I think the signaling is an important factor too.
It could impact the next year's sales because it's wrong.
It's a sticker shock.
Yeah, look what they
Sticker
did.
shock. Well, if it goes up another 4 next year.
Yeah, I mean, if you go up
Once you buy in, you're.
You
significantly.
don't care.
Yeah.
You do.
No,
Well, you do.
You do.
Here.
Okay. Any further discussion? All right,
So can I make a motion, maybe?
you can make a motion, Harry.
Let's see whether it succeeds, if it doesn't. So I make a motion that we raise it to 16,000.
You make a motion to recommend to the RWC board.
Right.
right.
That's
Oh.
where I get,
That's
that's where I
all.
get caught all the time, yeah.
Now, that we raise it to 16,000
Raise the MTF.
MTF, and then we raise it incrementally by 1,000. We'll put a time. limit on it?
Annually.
Through annual.
Annually,
Annually.
thereafter.
Yeah, annually thereafter.
Is there a second?
I second it.
So I have one point of discussion to
I
this.
was gonna say, any
Sorry.
further discussion?
Yeah. So based on this, what does that do to your projections, to your,
I think initially it pushes things out a little bit further
in terms of doing
in
projects?
terms of any additional projects. We're still maintaining kind of the base that I went over that are already somewhat programmed in. But in terms of being able to move forward on other things, it delays those a
When
little
did you
bit.
start those other things? Can we look and see that? What are you talking about? Because when was the break even, Kim?
2030.
So can we, where's 2030?
So slide down a little bit there, Todd.
Where's 2030?
You're in the wrong.
No, that's.
The wrong one.
No, that's the 18.
Yeah, but it doesn't show the
Oh,
projects.
down to the projects, okay.
So the big assumption is
This
still
one,
the
that's right.
400.
Yeah, yeah.
Yes,
yeah.
absolutely.
yeah.
Slide up,
but-
yeah, there you go.
Absolutely.
Right there.
Can't move
So-
three of the variables.
Which one's?
So this is, again, these are not in any kind of, this is me just plopping some things in, based on
That's right.
some assumptions.
Lawn bowling was
It's
a
in
million.
27.
1 million down there was the lawn bowling.
Right, and that's in 27. We don't see the,
27, 20, so the last column we see is the 2030.
yes,
The 807.
Yes.
Yeah, that's 2030.
the 8076, yes.
Okay.
That's how those are spread.
Yeah, so go down so we can see the bottom. So, okay,
So
so that's 2030 to what we see right there.
And
So what is he?
so
what
the
do we
deficit in the
I
meantime,
don't think that's 2030.
Well, To really do it right, we'd have to redo the whole, I mean, we'd have to move the bottom,
Yeah, we
you know
we can't.
what I mean? It's too hard to see
so
this.
the biggest deficit is
Can you go up, Todd?
in 26, and it's $1.4 million difference in the cash on a negative basis compared to what he's got there.
Right, that makes sense.
And then it
Because
starts
it's
building
immediate.
back up
Yeah.
to be,
So go down, what's $1.4 million due to 26?
So go down to the total, to
Total 26.
So we got
2.1 is the
we
the
got
net
two.
cash. Well, there's 6.8 really, but we want to keep 4, so that 2.1 is now $500,000. If that $1 million is spent in that year.
Well, that's why my broad
And nothing
question
else
was-
comes up.
Did it get
Yeah,
spent?
so we would, if that was the direction and that's what was implemented, we would make with the planning committee and through this committee adjustments to whatever the schedule is. Again, we approve 1 year at a time. So we don't have anything actually approved. Those are all just dropping things in to show you. So on a year by year basis, if that was the resources we had, we would monitor where the housing sales actually go, a number of factors that play into that. And we would develop the budget based on those parameters.
And the good news.
Come back in a year and.
And the good news is, we're just recommending to the board, they gotta make the big decision.
Oh, no, they're gonna listen to us.
No, they're not.
I would like to make an amendment actually
Okay.
to Artie's motion. I would like to make the amendment that we raise it to 16.5 this year, immediately. Because the 16 represents the movement of the trust fund maintenance expense from
Oh, you're right,
into cap. And so there's a $2,000, that $2,000 is just.
That's 200, the 2,000 times 400 is the 800,000.
Yeah.
Okay, go ahead,
Right.
yeah.
And so this way we'd be moving it up essentially, 1,000. So it'd give us a little bit more into 26.
It'll create less of a hole, which he was talking about.
That's right.
The out-
So-
in the near
Can you change your
Yes.
math real quick?
And then the 1,000.
Did you get a
It's
cost?
gonna-
in
it's only gonna
The
get better.
16's gonna go in.
16.5.
16.5 is gonna go in for 26.
Yes.
Is that what
And
you're
then
recommending?
1,000 from
Then
there.
bring the
And
break
then
up.
1,000 from
And I
there?
like an odd number because it
It's
doesn't
better,
sound as
it's less
better.
jarring.
16.5 versus 16, people
Yeah,
say,
no,
what's the
that's-
difference?
Let's
I
do
think
it.
it's 16,899.
999.99.
Yeah, let's not drive all the.
16.5, but
Yes,
I'm
but
only
there's not-
18 to move in.
There's not a motion on the
I know,
table.
no, hang on, we just wanna see the number. We're still dealing with that. She's whispering in my ear what I need to do parliamentary, so
Oh, good. Thank you, Deborah.
we're still discussing his amendment. Kim has it.
I do, hang on.
The friendly amendment is accepted.
No, not yet, not yet, it's not.
Okay, so now the break-even point is still in 30, but by a larger margin. So it's really almost break-even in 29, and we're only short by $200,000.
It would
So
take
it
the
changes.
reserve down to $1 million versus 2.1 in 27. I mean, the deficit, right?
No, in
Do you have
in what year?
You don't have.
27, so we're saying one of the
Oh, in
goal board is to have that $2 million.
Yeah, it'd bring it
reserve.
down to $1 million.
$1 million.
$1 million lower, so it goes,
Yeah.
the 2.1 goes down to
$1 million
1.1 rather than, yeah,
If we
so
were
that's
to-
right.
That's if
It-
you
that
would
was the
complete the
department
projects
head,
that
yes.
was kind of
Yeah.
put
Yeah.
out there.
But
And
we
that
don't know
confirmed it.
Okay, do we have,
Anyway, so we have.
do we have a second to the amendment?
So we have to,
We have to.
I'll second.
You wanna say
Second the
amendment.
amendment, second the amendment,
all right.
okay. Any further discussion?
Yes, I just have a point of clarification, which is there is no proposal on the table to accept the 18,000 increase that Jeff has
No,
proposed.
no, there is not. The motion
We
is.
could do that.
We could.
How could we, if we wanted to?
Well, then this, if you wanna do this, then you have to vote against,
Then we'll have another motion.
if you wanna do this, then you have to vote against this motion and get the 18, then motion for the 18. That was how you would do. Or you can amend it to
We'll do it the other
18.
way.
You can try and amend it to 18 and see if anyone seconds it.
Yes, the third amendment.
You can do that if you want.
That'd be the way it's done.
If you want to amend it to 18,
I'm gonna abstain on the.
Okay.
No, you can't abstain, you have to make a decision.
All right.
You don't have a conflict of interest, you need to vote.
Any other discussion? If not, again, this is a motion to raise the MTF, to recommend to the RWC board that we raise the MTF to 16.5 effective January 1st,
No,
no,
April first.
April 1st,
Of
2026.
Yeah.
And
This
then
takes-
increase it by $1,000 of every January,
Annually thereafter.
annually thereafter, on January 1st or April 1st. Does it make a difference? Or they don't care?
Okay, well, my math is annually, I
Yeah,
did
yeah,
not
got
do
it.
the
Yeah,
April,
yeah,
so
yeah.
but you know.
Okay, so that's the motion. It's been
So
seconded.
remove the effective date?
The first effective date is April.
I
Is
think we
that the
said
first
April.
possible effective date?
Well, it takes approximately 120 days because you can't have properties in escrow.
Right.
Okay,
And have the change occur. And so that's why we generally assume that it's gonna be 120 days.
Yeah.
why don't we just recommend the
At the
amount and let
next-
the board,
Figure out when it
when it
goes
goes into
into effect.
effect? Yeah.
Yeah.
We do that.
Is that okay, Adrian? You okay with that? Taking the effective date out? Just raise it to 16.5 with $1,000 increases, period.
Yeah, the effective date can be anything you want.
Because that was the original
That was the
motion.
original motion, no effective date. Okay, so 16.5 with $1,000 increases annually. That's our motion, roll call vote.
Green,
Yes.
Star,
Yes.
Castillo,
No.
one moment. Hines,
Yes.
Jennings,
yes.
Singh,
Yes.
and Byron.
It's kind of on the 18 side, but,
I took a
yes.
stand.
The motion carries.
Great.
Since I made the amendments.
You did.
All right, last item. I don't even know what it is anymore.
Oh, it's the sign.
The sign.
Sign.
A sign.
Who's talking about this?
Me,
Alright.
can I take up the sharing thought?
Shall please.
It's unplugged.
Oh, this one.
There you go.
So this continues the work that the marketing task force has done the past year, where we have decided to rebrand as Rossmore Walnut Creek. And marketing wanted us to look at everything, uniforms, internal communications, forms, everything, to be sure that Rossmore Walnut Creek is across the board our name. And so one of the things they wanted us to explore was the sign that's outside the gate as you come in at the corner of Tice Valley and Rossmore Parkway, where right now it just says Rossmore. And they suggested that we get bids for two different things. One would be a completely brand new sign there, so we're starting from scratch, and the second would be to refurbish it. So in the process of getting the bids, one of the companies, Golden Gate Sign, pointed out that we actually probably can't blow that up and do a brand new sign, because Walnut Creek, since this sign has gone in, changed their ordinance so that all directional signs, which is what this is, now need to be those green with white lettering. And it's a metal sign. So it would be a massively drastic thing if you blew that up and that's what you're putting there. So we're actually, staff's not recommending that we go that route. Instead, we're recommending that we look to refurbish the sign. So we got 3 bids. The lowest bid, we liked the company and their proposal. What they would do is power wash. They would pull that top part of the sign off, repaint it in the actual Rossmore green instead of, we're not quite sure what that green is. And they would, in addition to putting back the Rossmore letters, they would add in the brass Walnut Creek letters. And so essentially it's the same sign, it'll look nicer. I've actually talked with John T. and he said that there's some money in his budget that they could redo the landscaping so that it looks very nice out there with this sign. So at the planning committee level, they did recommend this. 2 people felt it was very important that the name rebrand be throughout, including that sign. One says, this is your first impression of Rossmore. You want to be sure they know it's Rossmore Walnut Creek. That's our name. There was one at planning who was concerned by the cost, because the cost is $15,937. That's for the project, taxes, permits, and contingency. In terms of permit, we just need to get a permit because there'll need to be a temporary sign there while they're painting and adding the letters. So it is a low permitting cost. But yes, the overall cost would be $15,937 coming from capital, and that would be to approve the project with Golden Gate sign.
Questions, comments, concerns?
I have a silly question. Is the green, is that the trim color on the security thing? Is that our color?
It's not our color.
Oh, thank God. Okay.
That is not our color, no.
Okay. Any other comments, questions? If not, does anyone want to make a motion on this?
I move that we recommend to Rossmore Walnut Creek Board to approve the expenditure for refurbishing the sign.
Is there a second?
Second.
Any further Harry seconded. Any further discussion?
I would just like to point out that there's a lot of signs around here that say Rossmore. And point, okay, and those aren't going to change.
Oh, you mean that?
They're on the highway.
Yeah, the highway
signs.
signs.
Yeah, well, we can't control that.
Exactly, so one more sign that says Rossmore by itself is probably not
So you're,
a major concern.
Yeah, that's what I feel, it's like, all right, whatever. It's just
But
not-
this is at the entrance, right?
it could use a little touching up anyway, really. It's a little tired.
Any further discussion? If not, a roll call vote, please.
Certainly, Rain,
Yes.
Star,
Yes.
Castillo,
Yes.
Hines,
Yes.
Jennings,
Yes.
Singh,
Yes.
and Byron.
No,
And Carrie consistent.
And we'll be contacting
Anything else?
the Department of Transportation.
If not, meeting's adjourned.
Yeah. Get on.